That's closing bell on Wall Street, and now it's market domination overtime. We're giving you full coverage of all the moves to get you up to speed on the action from today's trade. Yahoo Finance's Jared Blikre joining us now with the latest. Jared.
Thank you. We got a photo finish for the Dow. We'll pull that up on the Wi-Fi Interactive. Looks like it is down by 1 point, and that is a very small amount. So no record there. Nasdaq Composite, and let's show the chart there. That's good for a record high, by the way, up 1.11%. Also the Nasdaq 100 here, up a little bit more, 1.2%. And the S&P 500, about half of that, up 0.6%. And we'll throw in the S&P 600, which tracks the small caps. That was up about 8 or 0.9%. And if we get to the sector action, it has been a story of tech all day long. That finished the day up 1.75%, followed by industrials and then utilities. Those were the three outperformers. Then you have materials, consumer discretionary, and then healthcare. Those were the remaining green sectors. Energy was the worst performer, down about 0.6%, and close behind it, we would put real estate, staples, finance, and also communication services. And speaking of communication services, Google, a rare down day. That was down about 0.5%. But for the most part, the mega caps and a lot of the other stocks, the smaller ones, finishing the day in the green. And Nvidia might have a record there. Have to check that one, but that was up 2%. Broadcom up a little bit more. Tesla up 1%. But AMD really stealing the show after accelerating to that record high just a few days ago. Here's a 5-day price action, up 43% over the trailing week. And with that, we move on to the Dow. And we've got red, a lot more red than green on the right side of the board. That means some of the smaller guys in the red there. But Caterpillar up 3%, Boeing up 1.5%. Did mention industrials. Well, they closed at a record high today, along with tech and utilities. And let's skip over to our leaders index, because not a lot of red there. What was red was regional banks, low volatility, and then some bond ETFs. But ARK really stealing the show. That's the disruption trade, then chip stocks, IPOs, biotech, crypto, all of that banging today. And here's a look at that disruption trade, and you can see a lot of green there. So not just the mega caps, some of the smaller disruptors, and small caps didn't do that well, didn't do that badly either, I should say. And I'll throw it back to you, Josh.
All right, thank you, Jared. Well, U.S. stocks ending the day mixed as the S&P 500 and the Nasdaq return to rally mode. Investors remain broadly optimistic, we know, but there's also substantial demand for safety pushing gold up to new highs. For more on the head-scratch moves in the market, let's bring in now Keith Buchanan, Global Investments Senior Portfolio Manager. Keith, great to see you. Maybe start, Keith, just your overall view of the market, where we are, where we're headed, Keith. We have bulls on the show, including this week, who say, listen, keep it simple. Earnings are solid. The economy's hanging in there. The Fed's cutting. We're moving higher. You agree with that?
Well, thanks again for having me. We're looking at this with a little skepticism, frankly. With the most recent rally moving, as you just mentioned, to new all-time highs for some of the tech spaces and the Nasdaq, but still some faltering with the value-oriented spaces and some of the broader economic gauges that we look at, particularly from employment all the way down to consumer spending in different parts of that, part of the economy. And, consumer spending is more than 2/3 of our economy. So it really gets our attention when we're seeing some fits and starts down the spectrum of macroeconomic trends, especially when it gets to some of the wage earners that are more blue collar in orientation. So we're looking at this a little more skepticism. And frankly, with valuations at all-time highs here with, again, such narrow lifting of the markets from the AI-driven names, whether it's the recent investment that we're seeing, some of the circular capital movements in that space. Also, the earnings that we saw from last quarter helped to push the narrative forward. And we're not the ones that think that AI has completely overdone as some bubble of sorts. But the valuation and how far we are along in the earnings bonus really brings us a lot of concern. And we're looking at, also, we look at gold being up at $4,000, as you mentioned. There's a demand for hedging and safety that normally doesn't come with bull markets that have a ton of room to run in the very near term. So we're looking at this with some skepticism.
On the valuation front, Keith, it's interesting because bulls on the show will push back on that, and they'll say, listen, valuation is not, as we know, a market timing tool. And even if we're stretched, hey, things that are stretched, they can keep right on moving up and to the right.
Sure, we don't look at valuation in isolation. It always demands some nuance, and the nuance that we saw from last quarter, which in my opinion was a remarkable quarter, where we look at quarterly earnings as where storylines kind of meet spreadsheets, and where the rubber has to kind of start to meet the road, at least from an expectation standpoint. The backward-looking nature of them gives us some color as to what things are kind of moving the needle, if you will. The last quarter really set the stage for earnings growth that beat expectations in a way that most of consensus didn't expect. And coming in the next quarter, it also setting the tone for 2026. We're looking for that to continue in a way that hopefully spreads outside of the tech, communication, AI investment spaces that really power the markets with just astronomical earnings gains, as well as cash flow is starting to deliver as well. So again, we've seen follow through on an earnings standpoint that doesn't make us want to be underweight U.S. equities, especially from a tech side as well. But we don't want to make sure push all of our chips in that one piece on the board. We want to make sure we're more diversified, and that offers a lot of value in the way we look at the world.
So when you say diversified, Keith, what does that mean broadly? How do you want to be positioned?
We want to make sure we have exposure to the value cohorts that have lagged up to this point. There's a tremendous, from a historical standpoint, a gap between, from a valuation expansion standpoint, for value versus growth, and also large versus small. So we want to make sure we keep exposure to those spaces that have frankly been left behind in the most recent rally. Also, from a fixed income standpoint, we see a lot of value on the front end of the curve of treasuries. We're shying away some from corporate and credit. We feel like there's some risk there as those tight spreads we really don't feel like capture the moment of where we are from an earnings standpoint. Also internationally, we're making sure that as we come to a moment where it seems like the market is growing very skeptical of fiscal situations here, both here in the U.S. and abroad, we're making sure that we have diversification that capitalizes perhaps on that risk becoming more to the forefront. We have a position in gold that has obviously benefited from that skepticism growing. But also want to be wary of where we stand from an international standpoint. We have exposure there as well. So we're not all here in the U.S., not all large cap, not all growth. Diversification, we feel like, is the right place to be right now.
And Keith, finally, on the government shutdown, obviously as investors we're taught to look through that, but do you just look through that, or do you think this time is different? There are these threats this time of mass firings, and I think questions about, okay, well, what could that mean for the labor market? I'm just curious how you're thinking through it.
Sure. We feel like this time is different as there are more things hanging in the balance and not partial shutdown from a technical standpoint. So we're looking at the timing of it, again, with what's going on in the market. The market is pricing in. The market is pricing in optimism, and gold is screaming caution. And those two messages we were really taking very, very seriously as to which one is wrong at this point. Moving from the shutdown last week to today, we've had our third or fourth all-time high within the shutdown. We feel like the market is absolutely looking through this in a way that we're not necessarily certain of at this point. So we're a little more skeptical again of the way the market's pricing in this growing fiscal problem that we have here in the U.S. And this is kind of just an outgrowth of that, a symptom, if you will. And so we're not necessarily excited about, again, the valuation and the onward and upward trajectory of equities, particularly with such few names leading that charge, as there are growing concerns that we have here from a fiscal standpoint, and also just the political decision making and how the sausage is made, if you will. If the sausage is made in a way that there's a detriment to the labor market, that's already we're seeing pockets of weakness around in the U.S. In different industries, more so here in the U.S. in a more dramatic standpoint than we've seen globally in the very nearest last couple of months. We're really concerned about what that could mean as far as just the balancing of what the Federal Reserve is looking at for labor, as well as inflationary pressures that could come from international trade policies that are also shifting as well. So we have our concerns that grow from a geopolitical U.S. Policy making standpoint.
Keith, always good to see you. Thank you, sir.
Thank you.
Well, stablecoins may seem complicated, but they're quickly becoming one of the most important pieces of the digital economy. Yahoo Finance's Inez Foray takes a deeper dive into what they are and how they work.
Let's talk about stablecoins, because this is a type of digital or cryptocurrency whose value is pegged to an asset. Most often it's pegged to the US dollar. Now, so unlike Bitcoin, for example, or Ethereum, whose prices can swing wildly, stablecoins are backed by reserves such as cash or US short-term treasuries or T-bills to keep their value fixed. The market for stablecoins has exploded as of 2025, like you just said. Some estimates put that at $300 billion. Citi, for example, predicts that a figure could top $1.5 trillion by 2030, or $3.5 trillion in a bull case scenario. So what are they used for exactly? Well, inside the crypto markets, traders use stablecoins to move between volatile assets without cashing out to the bank. They operate 24/7 and settle quickly. They're also used for cross-border payments, digital commerce, trade, and they have the potential to generate yields when they are lent out on exchanges or decentralized finance platforms. And in countries with unstable currencies or where they just don't have easy access to US dollars, they have been a convenient option. A handful of companies dominate the space. The largest by far is Tether, a private company known for its coin USDT. Circle, which went public in June, you'll recall, issues a stablecoin known as USDC. Together, they control more than 80% of the global stablecoin market. The majority of the money that's backing those coins are parked in US Treasury bills. And that is a big reason why the US government is encouraging the use of stablecoins and passed landmark legislation over the summer, creating guardrails for the industry itself. Issuers have become major buyers of short-term government debt, effectively creating new demand for treasuries and extending the reach of the US dollar worldwide. So in short, stablecoins are becoming the bridge between crypto and the dollar and becoming a key component of digital finance.
The government shutdown is delaying President Trump's farm bailout. Farmers say it won't be enough even when it happens. Washington correspondent Ben Werschkul joins us now with more. Ben.
Yeah, Josh, this is another ripple effect of this ongoing government shutdown, and it's one of the clearest ones we've seen yet on the economic front. It was, as you mentioned before, it was just a few days ago that the Trump administration was promising a farm bailout would be unveiled, they called it substantial bailout, on Tuesday. Obviously, it's Wednesday now, so Tuesday came and went, and the message now, what we're hearing from the administration, is very different. I asked a USDA spokesman today for a status update, and the message is that they're assessing the situation and, quote, will explore the need for further assistance, but with nothing to announce or share at this time. A sort of shorter way of saying that is farmers are in limbo for this federal bailout that's promised. This is at its core is about the shutdown here, because the USDA, about half of the USDA staff is on furlough, meaning they just don't have the manpower to move forward on some of these plans. And we're also getting signs that Congress might need to be involved in a more fulsome way this time around versus the last farm bailout during President Trump's first term, which he was able to largely do unilaterally. Basically, the government funds might not have enough in them to execute a bailout as we go forward. This all comes, of course, as soybean farmers are in a real vice. You've covered this a lot on your shows as well, of just basically there's two trends happening here. Trump's tariffs have cut off the Chinese market. The Chinese have bought a total of 0 soybeans in the last few months. They've cycled down to nothing. They're buying from other countries, but not from the US at all. As well as the same time that we're in harvest season for soybeans, and all indications are for a bumper crop. So basic economics, a whole lot more supply, a whole lot less demand means prices are getting crushed. And one estimate is that soybean farmers are set to lose over $100 an acre if things go forward as planned. And all indications are it's going to go forward, at least on the bailout front, for as long as this shutdown goes forward.
All right, thank you, Ben. Appreciate it.
Mm-hmm.
Well, I recently spoke with one soybean farmer who has been struggling under recent trade and tariff policies with China. Blake Hurst is also the former Missouri Farm Bureau president and talked to us about what the bailout means for the industry.
Livestock, particularly cattle, are doing very well. Crop farmers like our farm are operating at a loss.
Why are you operating at a loss, Blake?
Because our prices 3 years ago for the bushel of corn was $7. Today it's $4. Our costs have remained the same. Same percentage drop for soybeans, or probably a little worse. So we've seen a tremendous drop in our profitability.
And Blake, my understanding is that in particular, it is the soybean farmers like yourself who are having a particularly challenging time. Is that accurate?
Oh, absolutely. Over the past few years, China has purchased 25% of U.S. soybeans. This marketing year, which starts in the fall, on October 1st, they have contracted for zero. So we basically, by a typical year, 10% of our crop would have been marketed to Chinese buyers. This year, we've sold zero. So that's obviously weighing on prices and makes a real concern about how we're going to even have room for this year's soybean crop. It's a good crop in much of the Midwest. We had a very favorable summer, but we're faced with low prices this fall.
So put some math on this for me, Blake. You will sell your bean crop for about what a bushel, you think?
Well, today, right around $10, and that's just barely break even on soybeans. Again, 2 or 3 years ago was $13 or $14 a bushel. So farming is cyclical, and this isn't our first rodeo with a drop in prices, but it has definitely been made worse by the trade war with China.
Let me ask you, Blake, if President Trump can cut some type of deal with Xi and get the Chinese to buy U.S. soybeans, what would that mean for your farm and for the industry?
Oh, it would be a tremendous boon to the industry if we got a deal. Of course, if we hadn't put our tariffs on in the first place, we wouldn't have needed a deal. We would have been operating in the normal market economy, but that's not the route we decided to take, and farmers are paying the price.
Well, here's, Blake, maybe, the Trump administration, I'm guessing, might put it something like this. They might say, Blake, what we're trying to do it's big, it's historic. We're trying to reform the global trading system, and there's going to be some short-term pain, but longer term, the objective is to put American industry and American farmers on firmer, fairer ground with stronger trade deals. What do you say to that?
Well, we put the first round of tariffs on China in 2018 during the first Trump administration. The Biden administration kept them in place. We've had 7 years to see how this experiment's going to work out, and so far it's a complete bust. There's no other way to put it. We have seen the administration announce a couple of trade deals. The most recent one with Taiwan, and they said, by golly, we're going to sell Taiwan $10 billion of agricultural goods in the next 4 years. The problem is, in the last 4 years, they've bought over $12 billion. So the deal that they're trumpeting is no better than the status quo. So far, we have not seen those results. So far, we have not seen an improvement in our position as exporters.
Let me ask you, Blake, the Journal is reporting here that Trump is considering $10 billion or more even in aid to farmers. What would you make of that possible response?
Well, if he sends me a check, I will spend it. But it seemed rather, it's crazy when you think about it. We put on tariffs, collect money, and then we take that money, which we've collected from American consumers, including farmers who buy imported goods. We take that money and give it to the industry that's been hurt by those very same tariffs. Seems to me that it would make a lot more sense to get rid of the middleman, drop the tariffs, and again, resume normal trade relations.
Let me ask you, Blake, what is your sense of how much farmers in the farming community still support Trump, despite, financial challenges?
The most recent polling I saw said 70% of farmers support our present trade.
Why is that, Blake? Why is that, Blake?
That's a very good question. It's because I think we're conservative. We like a lot of the things that President Trump has done in other areas. We're willing to give him a chance, but time is not on our side, and it's certainly not on the side of the Trump trade policy.
Final question, Blake. I am curious. Trump's deportation policies, what kind of impact, what kind of effect is that having on the American farming economy? What do you hear?
Well, that's the difference of what kind of farming. I'm sitting in a combine today, turned it off for a minute to visit with you. So we use a lot of machinery, and we're able to do most of our farm jobs with machinery, and so we don't depend on migrant or temporary labor. As it turns out, we have a greenhouse business, and we do use H-2A labor. They're legal, but we do use workers from Mexico. So I've seen both sides of the story, and for those farmers that have a lot of apples to pick, or strawberries, or any other crop that's picked by hand, the deportations are a real concern, I'm afraid.
Time now to watch Thursday, October 9th. Going to start off here on the earnings front. A lot of big names reporting on Thursday, including Pepsi, Delta, and Levi's. Delta announced results for the third quarter. Analysts expecting profit to be about flat in the quarter. The airline is saving money on cheaper fuel, but those gains being offset by higher wages for workers. Investors will be watching closely to see if economic uncertainty and weaker demand for non-premium travel are also weighing on results. And taking a look at the Federal Reserve, too, we're going to be getting a big batch of commentary on Thursday, including Fed Chair Jay Powell. This is coming after minutes from the Fed's September FOMC meeting on Wednesday. There was some division at the Federal Reserve's last meeting about whether to cut interest rates and by how much, but most agree the central bank could cut rates further this year. And moving over to housing, weekly mortgage rates from Freddie Mac coming out on Thursday. 30-year fixed rising for the second week in a row to 6.34% in the last report, signaling more challenges for home buyers in the housing market.